Hey everybody, thanks for tuning in. Today on the video, I have with me Sue Christensen, and she is a marketing director with Global Financial Impact. And we're going to be talking about something that is not exactly real estate related. We're going to be talking about rolling over your old SEP IRA or your old 401k. And that's not real estate related, but it does have to do with money, and real estate is kind of tied up with money. So I think it is going to be of interest to a lot of my viewers. So, Sue, thank you so much for joining me today.
Hi, Seb. Thank you for inviting me. It's a real pleasure to be here.
Right on. So, do you want to talk a little bit about yourself before you start talking to us about rolling over our 401ks and all that? Like some of your background?
Oh, wow. Okay. So I've been in this industry for almost 3 years now. I came into the industry first as a client. I myself had old 401ks and I didn't know what to do with them. And thank goodness I found somebody to help me. So that's how I came into the industry. Most of my background is in sales and marketing. I've been around the block a few times, so I've had a few jobs, a few different careers. So I'm multifaceted in a lot of different things.
All right, perfect. I love sales and marketing. So, okay, well, let me ask you this: like, what should I know that I don't already know about 401ks?
Well, I can tell you what I wish I would have known about how 401ks work. Typically, when you start a new job, you go in to do your hiring paperwork, and they hand you the paperwork. And what is one of the only options, if not the only option, that they offer you for retirement?
401k.
Right.
Yeah,
It's a 401k.
right.
That's really all that they offer is a 401k. So unfortunately I am guilty. I was guilty of this. Most of my clients that I talk to, we just fill it out. That's what we do. That's what we know. Everybody has a 401k. That's the vehicle that is sold to us. That's a vehicle that people mostly talk about. So I just signed up like a good little soldier, and then it was set it and forget it. Was terrible with following what was actually happening with my 401k. I'd get my statements and file them away. And then when I left, and when you separate from your job, you also separate from your 401k or your traditional retirement account. I did not know what to do with that. I had no idea what to do with it. So I just left them both there, one for about 20 years, one for about 25 years. And what I wish I would have known is what to do with them, because I would definitely be in a much better position than I am now if I would have understood the importance and the actual what happens to your money if you leave things in your 401k. It's never good to leave anything, especially for 20 to 25 years, but especially a retirement account, because we want those during retirement. So if we're leaving them, we're leaving money on the table. We can't contribute. It's losing money in the market, and I'm still paying fees. So I wish I had the foresight. I wish I would have educated myself. And unfortunately, in our country, we don't talk about money. I grew up in the 80s. I remember my parents talking about the market crash, and that was pretty much it. We're not educated. We don't learn in school. Unfortunately, most of us as adults, again, most of my clients, we really don't have a basic understanding of how these things work. So I'm going to talk a lot about education today because that's incredibly important, especially being able to talk openly about money and how it works. If I can have one person not lose the money that I did by leaving old retirement accounts in another company, then my time here is really well spent. So education, take things into your own hands. If you don't know anybody to talk to about these kinds of things, I'm happy to talk to you. If you have somebody else that you know, I would encourage everyone to have this conversation.
All right. So what do I do? So I have a 401k, maybe a couple of them, or I have a SEP IRA. So what's better than just leaving it there? Like what are my options?
Well, so traditional retirement accounts are all in the market. They're all variable. So once it's a variable account, It's always going to be a variable count. We can't change a chicken taco to a steak taco. But what we can do is get it out of the market, move it over into a fixed indexed annuity or an FIA. So once we move it out of that variable account, we get it out of the old company, we move it into a fixed it's easy for me to say fixed indexed annuity. I'm going to say FIA from now on. So that will give you principal protection, right? You also have the opportunity to have income for life, no loss, and guaranteed growth. So, and also probate protection. So all of those things that we have with the fixed indexed annuity are not a component of the 401k. The only component that they have in common is growth potential, and that's it. That's the only way that these two accounts are similar.
So you say that if I move into an FIA, a fixed index annuity, that the principal is safe at that point. So how does that work?
Okay, so it's really just a transfer of risk. So the insurance company is taking all the risk up front, right? And there are guaranteeing that you never lose any money again, because it's illegal for insurance companies to allow you to lose money. So they have to guarantee that principal protection. It's a non sequitur. They have to do that.
It's just regulation. It's regulated that way. So
Yeah,
an FIA is run by an insurance company. Is that?
yeah. So FIAs can only be purchased or set up through insurance companies. So it's investment grade insurance. So that's why it has different regulatory guidelines and restrictions on it. So when you move it over from the variable account, right? So that's why it has all of these benefits on it, because they legally have to provide those different types of benefits for your account. So only insurance agents, only licensed insurance agents are able to talk to you about these products. Your financial advisor can legally, unless they're licensed, they can't talk to you about these. And actually, most of them really don't know how they work, or even if they know how they work, they don't really want to talk to you about them because they're not licensed.
So that's interesting. So like if I go to like Schwab or like Edward Jones or somebody, they're not going to know about this at all because they can't legally solicit funds for these kind of annuities. Is that correct?
Right, because they are securities licensed. So they have a securities license. They don't have the insurance license. So even if they have heard of them, it's really very, very minimal information, because when you like this, certified financial planner, the traditional education that they receive, the tests that they take, the amount of information on an FIA is minuscule. It's not covered really at all. So they have no idea how these work. And even if they had maybe an inkling, again, they're not licensed, so they can't legally talk to you about them or even go into any depth about them. And most, if not all of the financial planners are fee-based or fee only. So when they sit down with you and they put together a strategy for you, and they plan out your financial future, they're going to get a fee for that. So every time you sit down with that financial planner, they're going to charge you a fee. They're also going to get an annual fee on your account of maybe 1%. So every year, they're going to get that annual 1% on whatever your account made. And again, every time they sit with you, they're going to make money because they're going to charge you a fee. Now, with this investment grade life insurance, it's commission based. So the companies all pay us the commission, right? So it's one and done. So the financial planners are more interested, in my opinion, they're more interested in the fee-based model. And if they did get licensed, then they would not be able to do the fee-based. Does that make sense?
Well, they probably could do the fee-based when they were doing securities, but not when they're doing an FIA, I guess. So you mentioned a commission on the FIA. So who pays the commission? Does the investor pay the commission? Like if I'm giving over my SEP IRA, do I pay the commission at the time I transfer it over, or how's that work?
No, everything we do is complimentary for our clients. You'll never be charged a fee for any time that you spend with me. The insurance companies are the one that pay us. So we work with you, we put together a plan for you, and then whatever insurance company that we decide is best for your financial needs and goals, that's who will pay the commission. It never comes out of our client's pocket ever.
So the insurance company pays you like an acquisition cost essentially for bringing the business to them. So are there like many different insurance companies that have FIAs? How many are operating like in the United States or whatever?
Well, there are a lot. Most of them do offer them. We work with over 25 different Fortune 500 financial companies, and all of them offer FIAs because it's a really a niche market, and it really oughtn't be, because again, there are so many people. I'm a poster child for it. So many people that have their old 401ks that really don't know what to do with it. You see advertisements, for Charles Schwab, for Fidelity, for Vanguard. You see them advertising, you see their websites, the only products that they offer are the variable accounts. Well, the insurance companies don't do that. We really are basically their advertising. Nobody really knows about them because they're not out there in the marketplace. They're not being promoted by the insurance companies as like the Fidelities or the, Vanguards of the world. That's what you see when you go onto their website. You know exactly what they offer. If you went onto an insurance website, you wouldn't even know what to look for. And if it said, you wouldn't
Right.
know.
Yeah, I would not look for that on an insurance company website. So let's just say that I bring over $500,000. So there's no fee, right? So I'm going to see in my FIA, I'm going to see $500,000, no fees. But are there any like monthly fees or yearly fees, or there's just never any fees?
Oh no, I mean everything has fees. You're never going to get away from fees. Everything has a fee. The question becomes, do I want to pay a fee to lose my money or to never lose money again?
I see. Okay. All right. So there are fees, but what is the return like? I mean, like if I'm in the stock market, or whatever, maybe I'm seeing 8% a year. I don't know what I'm seeing, right? But is it similar to that? Is it worse or better or what?
Well, it's similar to that, and each account can be structured differently. So it really depends. But yeah, you could see 8 to 10% growth on your account. But again, I think that people forget about what we're losing in our account, right? It's about what we end up with at the end of the day, as opposed to what we're seeing in our account on maybe a daily or monthly basis. In 20 years when we retire, so the average 401k balance for people 60 to 69 is $190,000. Is that going to help anybody retire in our country?
Well, not really.
Not really. For a few years, right? But so these come with the fixed index annuity, FIAs, they have income for life. So there is a component that we can structure so that you will never run out of money.
Okay. So what are the downsides on getting a FIA? Like if I give you the money, can I ever get it back and reinvest it elsewhere, or how does that work?
Oh yeah, I mean it's your money. It's like your 401k, but again, it has those same rules. So when you withdraw the money, you're going to pay tax, just like the 401k. If you withdraw it before 59 and a half, which I found out the hard way, you're going to get penalized 10%. I got a horrible tax bill because I didn't know I was going to be penalized to withdraw my money before 59 and a half. So you do the same thing in the FIA. You take it out too late before 73, it's required minimum distribution. If you take it out too late, they're going to penalize you too. So there are those guidelines that we still have to follow because it came from a variable account. So it still has the same rules and guidelines, those IRS guidelines. We're just able to protect it, protect our principal income for life. So it just has a lot more benefits And especially because we're talking about moving old money. So there's literally nothing you can do with that old account. In this account, at least it's safe and it's growing, right? So if your old account, you're probably not getting 8 to 10% a year because it's eaten up in fees and you can't contribute.
Okay. So if I have an old 401k or whatever and I want to move it over, but I'm not 59 and a half, let's just say I'm 58. Can I not move it until I'm 59 and a half without paying a tax penalty? Like, does it count as a withdrawal if I move it to an FIA?
No, moving it, you won't get penalized because you're moving it from one retirement account to another. So as long as you're moving it to a retirement account, they can't do anything. They can't tax you until you pull it out of the other retirement account that you're moving it to.
Okay. So there's no age limit on going into an FIA. So I'm 54 right now. I could move my IRA over there right now today,
Yeah,
and I would have no risk of principal loss, which is something I've been seeing in the market, people losing principal left and right these days. So people
yeah.
at FIAs are not seeing any principal loss, is what you're saying right now, even with all the market volatility.
No, and again, the insurance company is legally bound to, you're never going to lose your principal ever. That's just the way that they work. It's guaranteed no principal loss, and
So
you won't ever lose that.
so that also means like that the interest or whatever is also not, it's a fixed rate, right? So like they're going to say, okay, you move in this amount of money, and then we'll give you X% a year out of that, like guaranteed. Is that correct?
Yes, so again, we can structure it in different ways. Some of them will have a cap of 8 to 10%. Some of them will have a cap of higher. So there's a cap and a floor. So say the market does 15% and we're capped at 10. So we're going to make that 10%. Say the market drops down 15%, that's we're never going to lose money. Our floor is zero. Some have a higher floor, but we'll just say zero. So this is where zero is your hero. So everybody else lost 15%. I didn't lose anything. So let's just say I give you $10,000 to attack your retirement priorities. Would you rather have negative or positive returns?
Positive returns.
Right. So $10,000, I mean, that's a no-brainer, but so you have $10,000, right? And say the market goes up 50%. So now I have $15,000. The next year the market goes down 50%. So now I have $7,500. So I'm lower than what what I have now is less than what I started with. In a fixed index annuity, that won't happen. If I start at 10,000, right, the market goes down 50%, I'm going to be at 10,000. The market goes up 50%, I'm going to go up 50%.
Right.
So
Well,
I'm
so
never going to,
this is like perfect for people who are older and don't want to take like a lot of risks, essentially, right? I mean, like you hear about that, like what's your appetite for risk, and that will depend, that will determine like the kind of investments that you should be making. So, what if that like like I'm 54 right now, I move my SEP IRA over right now, but I don't want any disbursements because I'm not retirement age yet. So all the money that I would be making, can that just be reapplied to the capital and have that keep growing, or no?
so say that again.
So let's just say that I don't want any disbursements, right? Because I'm too young. Like I want my money to keep on growing. So like if I'm getting 10%, let's just say, as my annuity, but I don't want to take it. Can I just have that just be reapplied to my principal balance and have that grow while I'm waiting to take disbursements, or no?
Well, yeah, you don't have to take your money out if you don't want to. There are a lot of different strategies. But you just keep it in there and watch it keep growing, right? So 73, you're going to have to take it out. That's again, it's required minimum distribution. But at 59 and a half, there's no other age restrictions unless you're taking it out at 59, before 59 and a half, then you're going to get the penalties,
Ah, so at 73, I must start taking those distributions, right?
yeah, you have to,
By
yeah.
law, I guess is what you're
That's
saying, right?
that's
Okay.
the IRS guideline.
And so,
But
but so the percentage of distribution is going to be set up at the time that I set up the FIA, is that right? Or can it be changed at any point? Or like once you're locked in, you're locked in?
No, I mean, as far as distribution, there's no, you don't have to take any money out. What we typically recommend is that you just start taking out the interest. So whatever the account grows, right? So you're not touching your principal, you're just pulling out that interest. So you're pulling out the interest, paying tax on a smaller amount. So you can just keep letting it grow. You don't have to take any money out. But again, there's different strategies where you pull that money out, the interest, you pay the tax, and then you can reinvest that into another account that is meant for after-tax dollars. And again, that's an indexed account as well.
Right. But would that be an FIA also, or would that be like a securities account that you would recommend for that?
No, we don't do security, or I don't do securities account. We don't do securities account. That would be another insurance-based product.
Okay. All right. There's different, so different products that they can talk about. Okay. All right.
Mhm.
So this all sounds really great. But if it is so great, how come like it's not more popular? Is it really just because of the sales channels that are used, or are there any more downsides that I'm not seeing?
Well, so there are quite a few reasons for that is because again, we don't really talk about money in our country. And if we do talk about it, it's the 401k. So people just aren't educated. We don't, again, this I'm talking from experience, we don't take our own retirement into, we should be taking it into our own hands. We should be the one driving that retirement vehicle, but unfortunately, we're not. We're allowing our employer, here you go, this is your 401k. I'm like, okay, I'm going to do the 401k, and off we go. Or you go onto a bank. What do banks typically offer you if you walk in and you want to a
CD.
retirement? Right, a CD, maybe an IRA, or a high yield savings account, and they're not going to talk to you about an FIA. We've already mentioned that your financial planner isn't going to talk to you about an FIA. So unless you know somebody like me, unless you know an agent, an insurance agent, or you're Googling trying to figure out, an alternative to your 401k, it's you're just not going to know. I had no idea until I was horrified with how much money I was losing in my 401k, and a friend of mine like, hey, you should talk to my friend. And that was when I was like 55.
Right, right behind you. So how do you know if an FIA is good for you? Like, is there any kind of like telltale sign that you should be doing an FIA or that you should not be doing an FIA? Like, who's it really the best fit for?
Well, you mentioned it earlier, it's about your risk tolerance. So, if you're okay losing money in the market, if you're not worried about, running out of money during retirement, if, you're okay with having no guarantees on your money, then you have a high risk tolerance. So this might not be the vehicle for you, but if any of those are a concern, I know my big concern was running out of money during my retirement. And again, I know people who are in their late 60s to early 70s who've had a significant amount of money in their 401k, but now they're running out. And so that's the big concern. What are they going to do? Do I have equity in my house?
All right, well, so this all sounds great. So if I wanted to, to talk further about this, how would I reach you?
Well, you can call me. That's probably the easiest one. I don't know if we put my
We
email
can put
up.
it right here virtually. Consider it at the bottom of the screen right now. What phone number should people call you on?
408-748-4862.
Do you have an email address or a website you want to share as well?
My email address is Sue, S-U-E, at mygfi.org.
All right, well, that's pretty easy. Okay, all right. And so, well, I think that's really all the questions I had, but maybe there was something else that I should have asked that I didn't ask. So, is there any questions that maybe I should have asked you that I somehow neglected to?
No, I think you asked some good questions. But all I would say is if you're curious, if this, piqued your interest at all, I would reach out. Like I said, even if it's not me, I would find out more about my own retirement accounts. If I can, help one person not have to go through what I did, then I would just encourage everybody to take a look at your 401k. Again, it's an old 401k. Let's do something with it. It's not doing you any good just sitting around there losing money right now. So if I can help you in any way with that, that would be, my pleasure to do that, because somebody helped me and it really changed my life. And so, it's, you know, turnaround is fair play. I want to be able to, pay it forward to help somebody else not be in the situation that I found myself.
Well, that is a very good why. So, thank you so much, Sue, for sharing all this with me and my viewers. And I know that I actually sure learned a whole lot, and I'm excited to learn more. So, thanks again for taking the time.
Thank you, Seb. I appreciate it. It was nice to see you again.
All right, good seeing you too. We'll catch you on the flip side.
All right, bye.
Okay, bye bye.